Okay, you're going to be hearing from me today, as well as Alexa Kane, certified financial planner and a financial planner here in our Dexter office, as well as Melissa Fradenburg, who's a financial advisor in our Grosse Pointe office. And we're going to be taking you through what we're seeing in the economy, where we've been over the last year especially, and then where things may be going. And to get started, let's talk about the agenda. I think that it's inevitable that we need to discuss COVID-19 in a year like today, and then we'll get into the economic recovery, talk about stimulus as well as the bond environment, and then what we see in the stock market and specifically within sectors, and then review asset allocation. If you have questions, as you have questions in the presentation, please email them to me at melissa@pearlplan.com. And I'll be happy to share them with our panelists, and we'll get back to you today. And then additionally, don't hesitate to email us as follow-up as well. But I'll be checking those questions at the end of the presentation. So when you think about, and if you've been at our presentations in the past, I'll just mention that we often, our investment strategy is a combination of Raymond James strategy, where we custody our assets, and the strategy of Pearl Planning. So this is kind of an integration of both. You're hearing our perspective today, but we also have the, strength and background of Raymond James. And this is a look at the Raymond James investment strategy group that provides information. So, if you think about a wealth management firm, here in Michigan versus a global firm that has a public health perspective coming from their healthcare strategist, chief economist, et cetera. We really love the combination, and we think that has been a critical component of our ability to navigate through the last year. So let's get started. We'll talk about COVID-19. And the first thing, especially sitting here, I know many of you are across the country as well, but looking here in Michigan, you'll realize that we're in the middle of our fourth wave, whether the country is going to go there or not. And COVID-19 has been an extraordinarily severe and just harmful disease. This is a look at the pandemics of the past relative to COVID-19. And we have a death toll that is much more significant than any pandemic or health outbreak over the last 70 years. And in fact, we're approaching the levels of the Spanish flu of 1918 in terms of loss of life, which was 675,000 about 100 years ago. The good news, though, when Raymond James Investment Strategy Group did their sentiment survey, they found that 50% of respondents already had received their vaccine, 35% planned to, and then there was a gap of 15% that would not. But that's getting us close to the goal that we know public health experts have, hoping for a larger community immunity around 70% vaccinated. And when you look at why that matters, you can see some real-time information that we're getting from a vaccine a group that's ahead of us. So Israel had 25% of the population vaccinated back in mid-January. And then you can see the relative decline after that percentage of population was vaccinated, and their total vaccines continue to grow with the decrease in the number of COVID-19 cases. So that, per Dr. Scott Gottlieb, is information that is relevant in terms of US progress. Now, when you look at the US relative to the rest of the world, and this matters in terms of how we look at how we look as investors, the US is on a much faster pace for vaccination than the rest of the world. So in this chart on the right, US versus world vaccinations, you can see that we're on a pretty hyperbolic trajectory for the percent of the population that will hopefully be fully vaccinated relative to the forecast for the rest of the world, which puts international communities at going out until 2023 to get the same level of vaccination. So that pace is very encouraging in terms of our domestic location. And looking back, let's take a trip back because really we have over the last 16 months experienced a lot of life, right? So you have the Wuhan lockdown starting in December, January of 2019 through 2020. Then you had the start of, kind of the precipitous, very severe decline in markets that occurred in February to March. Then the Fed announced its QE program as well as the CARES Act, I would consider a historic stimulus package. And the markets revisited and markets as measured by the S&P 500 revisited pre-COVID levels by late summer, and then have continued to improve, in fact, better than prior to COVID-19. After that, we have important dates, including the Pfizer efficacy date, the final outcome for the presidential and Senate elections, as well as another stimulus package that was passed, which I would argue was because of the results in Georgia. Now in bonds, the opposite happened. Yields plummeted as COVID-19 became a world pandemic. And then they stayed low for most of the summer, but bond yields have actually been rising as we have gotten into this year and even the end of 2020. And so that has impacted returns in the bond market. If you'll recall, bond returns are counterintuitive. When yields fall, returns go up. And when yields go up, bond returns go down. So we've actually had what could be considered a bond bear market in terms of the yields more recently. But that in terms of overall portfolio health with diversification has provided the benefits of bonds without harm or damage in portfolios. Now, looking at the COVID crisis, I think it's important to note that you look over the last year and the resilience of the market, and you have to factor in the stimulus that occurred in the economy. This was the biggest fiscal rescue, biggest stimulus packages, biggest efforts by US Congress to attack a recession that we've seen, at least in my career and I think in history. So you can see a comparison of the coronavirus relief that we've had in these first days. And this actually looks out to the stimulus that will be received going through 2022. That's the dark blue on the chart on the left. And then compare that to the Great Recession. I think lessons were learned in 2008 and 2009. And so there was a much broader, stronger response in terms of the reaction to COVID-19. So you look at the balance sheet of the Federal Reserve, and that balance sheet is getting very, very large, very accommodative. But you'll notice it actually had been large even coming out through and after 2008 and 2009. And when you look at this total stimulus, you'll notice that the stimulus in the COVID relief was equal to the economies of Japan and Germany combined. So they're a huge portion of our GDP, and that has resulted in historic moves, but also resilience in the market. And so then going on, we expect the economic activity to continue to improve. And in fact, it could be the best quarter in terms of or the best kind of economic growth that we've seen in the last 34 years coming up here. Just historic numbers, but we're coming off of that huge decline in GDP in the second quarter of 2020. So the one-year numbers have a very extreme, kind of precipitous decline baked into them. So growth prospects have continued to improve, and that is all about the two things. One is more stimulus. So forecasted as of 12/31, this is what the Fed was looking at. They forecast about $1 trillion in stimulus, but we have this light blue line, which was added in after the power in the Senate was shifted with the Georgia Senate election outcome. And then we've also had a faster vaccine ramp up, which has contributed to a more optimistic economic outlook across the board. So there have been revisions both from the Federal Reserve, from Raymond James economists and consensus economists across the board, that the economic environment continues to improve faster than we even thought in December of last year. And the real concrete numbers are showing that too. So here is a look on the right about the expectations for mobility. And in the light blue is the forecast of what would occur after the new year, so starting in 2021. And then in the, here's the actual numbers in green, where you can see that mobility has spiked in advance of what was anticipated. With mobility comes spending, so the US consumer is seeming to get back into the game. And here we are, consumer spending. Consumers have more money than they anticipated that they would, and that has a lot to do with the stimulus. And so the consumers are putting that money into the economy. You can see that in real estate, you can see that in retail purchases, you can see that in equities. And, you know, again, we can't emphasize enough how the stimulus has impacted results in markets. And I also think that it's an important time to take a pause and reflect back about your thoughts and emotions when it came to the economy and investments over the last year. I think that there's a lot of humility that can be related to, you know, kind of lessons learned from 2020 and 21. I would personally I always feel comfortable saying that it is very difficult to predict markets. And I think the last years for me, that's just more reinforcement of that philosophy, which may feel uncomfortable. It feels uncomfortable to be uncertain, but I also think that you know, it's more important to use the processes that you can rely upon to navigate through uncertainty than to have you know, the relative feeling of control, which often can result in harmful behavior as an investor. We also have building consumer confidence. I think that this is, when you see the gaps here, it is correlated to waves of COVID as well as just general economic uncertainty. So we'll see how those go as the days and months unfold. But as we look back, and right now we are just at the inflection point, a year into the inflection point of when the new bull, we had an extremely short bear market, just a month or two, and then we went into a new bull market phase. And looking at this most recent bull market, it was extraordinarily strong. Over the first 250 days, 75% returns compared to bull markets in the past. Now, what happens in year two of a bull market? Because remember, the bull market didn't start on the calendar year. It actually started mid-2020. And year one is typically very, very strong. And this is looking at what happens on average in year two. Still returns that you would be looking for if you had a choice in equities, but not quite as strong as year one, but still quite positive on average. Now, of course, past returns can't predict future returns, but I think this information is relevant and something that you can take into consideration. So with that, I'm going to hand the microphone off to Alexa Kane. Alexa, talk to us about stimulus packages and a little bit about bonds.
Yeah, I've got the fun stuff coming up. So first, I'm just going to touch on a couple differences between the rescue package we saw earlier and the recovery package coming through, and why we don't think there will be a large immediate economic impact from the recovery packages. So when we look at the rescue package and the distribution period for that, the money came out really fast. It was hitting bank accounts almost immediately. And the projection is 84% distributed over the next 2 years and completely distributed by 2022. What we're seeing on the recovery package side is a 8-year distribution plan. So evenly distributing that out until 2029. So less money over the longer period of time. And then the other big difference between these is the funding mechanism. The rescue package was 100% deficit funded. So They issued debt to create that money and get it out in those pockets very quickly. And the recovery packages, they're planning to use 100% pay for. So on the infrastructure side, they're looking to raise corporate taxes, and on the social side, raise individual tax rates. So by using the tax rates to get those funds, there's less money for the individuals and the corporations to spend. So less will be going back into the economy. So we definitely have a lot more compromises and changes that we'll probably see on these recovery packages before they go through, but we're not expecting as much economic stimulation from the recovery packages. And then looking at the interest rates, we are not anticipating a rate rise until 2023. That's what the Fed has said, but there's a lot of news out there or talk in the markets about the rising rates. Historically, looking back at the last 3 recessions, it was typically about 4 years before there was a rate hike. The first 2 closer to 2.5 years, coming out of 2008, 2009, that was 6.5 years. And even if we're looking on that low side of the 2.5, that puts us right in 2023. And we do think that the Fed is going to be really patient and not, take into account that chatter and just move slowly with rate hikes going forward. And right now, the Fed is focused on its 2 mandates. And the first one is stable prices, and the second is employment. And when we look at inflation, that dotted line on the right side does show the anticipated inflation going forward. We are looking at a pop above that 2% inflation, which makes sense given how low we went last year. And as Melissa mentioned, people are ready to spend their money. So a bunch of people spending at one time, we think it's going to rise up, but then over the long term, really stabilize around that 2%. And right now, we think the Fed is a lot more focused on the employment side of things. If we look the beginning of the pandemic, where the employment dropped, we've seen a big increase, but we're still about 8 million jobs short of the pre-pandemic levels. And the Fed has talked openly about not just looking to reduce that 8 million, but to broaden its scope and have more fine-tuned goals about making sure everybody goes together. So looking at the Black unemployment rates, are the lower wage earners, are they growing as well? And then the participation of high school graduates in the growth. So that definitely won't happen immediately, and the Fed is really going to take their time on that. Moving on to the fixed income side, and we have seen the rates rise this year, and we think it's for the right reasons. And the chart down at the bottom shows the GDP growth forecast, and as that's been going up, our expectations are increasing and improving. The 10-year Treasury yield has been rising right along with that in that light blue line there. The anticipated inflation rate rising, we also have that pressuring the interest rates as well. And we're looking at a 2% target for the end of 2021. And as Melissa mentioned, when the rates go up, the bonds, move opposite, and it does have people asking, why do we have bonds, and is that still how we want to be allocated? We definitely do still see the need and the value of bonds in a portfolio. The chart on the left shows the max drawdown. So from the record highs, the drawdown percentage when we hit those recession periods, down 40%, 55, last year about 34%. And then the fixed income is in that light blue. So we see a much more muted downside risk. So having the bond portfolio does help to dilute that volatility and also give some stability to the portfolio. And the fixed income side is one of the few places you can pick up a little bit of yield. So the investment grade, looking at about 2.3%, emerging market bonds, you're looking at about 4%. So we do still think they're a valuable part of the portfolio. And I'll let Melissa talk more about the equity side of it.
Yes, so thank you, Alexa. And I'm going to talk about why we remain optimistic on equities. So if we go through some of the reasons, before actually I go through some of the reasons, just a quick statistic, Raymond James Investment Research did a sentiment survey and found that 95% of respondents believe that the S&P will be higher by the end of 2021. And so do we. So I'm going to talk about why we feel that way. The first one, which Melissa did and Alexa touch on, is accelerating economic growth and the stimulus. So bull markets rarely end in strong economic conditions. Also, balance sheet expansion by the Fed, the saying, don't fight the Fed. Well, we believe that they're going to remain accommodative for the foreseeable future, which will be good for equities. One of the biggest reasons, COVID containment. So at the current vaccination pace, we're looking at potentially the economy being fully open by the end of May and potentially having herd immunity by the end of July. With those two things, that should continue to be a positive for the equity market. Also, dividends and buybacks increasing. So if we expect dividends growth to be about 4% this year and buybacks likely to increase significantly, those are also factors that favor equities. The biggest one, earnings growth. Raymond James has an estimate of earnings growth of 38% for the year. That would make it the best year in earnings growth since 2010. Also, that is slightly higher than consensus. So Raymond James feels that as consensus continues to increase their estimates for earnings growth, we'll continue to see equities move higher. Now, the last one, I'm going to go through a few slides just talking about some myths versus realities that you may see in the headlines. Next slide, yep. All right, so some of the things you're already seeing and we will continue to see that could have a negative impact on the equity market are rising rates, inflation, Fed rate hike, and tax increases. But let's take a look at what this actually means for the equity markets. On the next slide. So if we look historically, all the way to the left-hand side, we have what happens when we have rising rates. And over the last 12 times that we've had a rising rate environment, you'll see that it's almost always positive returns, with the exception of twice, for that environment. And on average, it's a higher than average equity return in that rising rate environment. So we do not feel that that is going to be an issue. Also with inflation, if you look at the middle chart there, that yellow box is inflation rate of 1 to 5%, which we feel is well within the range that we would see over the next year. And that is what we would consider a healthy inflation rate. And in fact, will give companies some pricing power, which is not necessarily a bad thing. Then we also, leading into that first rate hike, again, we feel that it's 2 years out, or 2023. And if you look at historically 2 years leading up to an interest rate hike, there is a 100% chance of positive equity return. Or I should say 100% of the time leading up to 2 years before rate hike, we've seen positive equity returns. If we are wrong and it actually is 1 year out, once again, also 100% historical positive returns 1 year before a Fed rate hike. If we're completely off base and they actually raise rates this year, either 3 months, 6 months, or 9 months out, there's still a 70% chance of positive equity return. So really, that rate hike concern in the headlines is not something that we feel with a strong economy and positive earnings growth that is going to be a risk that could offset positive equity returns. The other headline that you will see, which is very possible and most likely happening, which would be corporate tax hikes as well as individual tax hikes. And if we look at historically what the equity market has done, there have been 4 corporate tax hikes since World War II. And you'll see on the left-hand side in that chart, there 6 months before and 6 months after, we have seen positive returns for the S&P surrounding those corporate tax hikes. As far as individual tax hikes, very similar. You see in those years where there have been tax hikes, like the last 2 times in 2012, we saw the S&P return almost 30%. And in 1993, we saw a positive return of 7.1% for the S&P with those individual income tax hikes. So we do not feel that that is necessarily bad news for equities, either of those 2 scenarios, again, as long as we have a strong and growing economy. So we like equities. Let's talk about specifically what sectors we like within equities. So due to the stronger earnings growth and improving economic activity, we do favor cyclical over defensive sectors, specifically information technology, industrials, communication services, financials, and consumer discretionary areas. If you see over on the right-hand side, that is the area where we have stronger earnings growth. And again, those are the areas that we currently favor. You may say, why do you still like technology? It's had such a good run. And certainly coming out of COVID or during COVID, that's when a lot of technology took off, but we do see a lot of areas that will continue to grow as a result of COVID as we come out of this. One area is online retail. We have a projected growth of 6.1% for 2021. A lot of people have become used to using online retail, and we continue to see that trend going in the next few years. Digital ads, that can also be a recovery play as we see areas like airlines and hotels and restaurants trying to bring clients back in. As the economy opens up, they're going to be taking out digital ads. Broadband, that is an area where Biden's infrastructure proposal has about $100 billion going towards broadband. Artificial intelligence, again, that is a way that retailers and companies are looking at having retail sales, but not having a lot of contact with their customer base. And then with financial technology, I just had this happen the other day. I went to go pay for a pizza I was picking up for the kids, and they won't even accept paper dollars. It's a complete paperless transaction. We'll continue to see more companies moving in this direction as a result of COVID, even after the economy opens up. So we still like technology in those areas specifically. Now, as far as within equities, we favor the US over international. And as Melissa touched on, just the rate at which the US is vaccinating, we are actually vaccinating 3 times. We have 3 times as many people vaccinated here as in Europe. And what this means is increased mobility, the economy opening up faster. So we do believe that that will carry through both in earnings growth, and we see that in the earnings growth revision so far in 2021. You'll see on the right-hand side, the S&P goes positive revisions upward 5.1%, almost double that of Europe. So again, we favor the US over the next 12 months. And in the next slide, within international markets, we favor emerging markets over other developed. And we continue to see, specifically in emerging markets, Asia over Latin America, just due to the stronger growth forecasts. And we still have relatively good valuations in this area. And in fact, if you look specifically at Asia, India, and China, we have 11.5% forecasted GDP growth for 2021 for India and 8.1% for China. So within that area of international, there are some pockets of strong growth, and we like those areas. One thing to mention with all the stimulus that has, kind of contributed to this growth, we do have an increase in the money supply. So the Fed has basically been printing dollars, and we've been widening the deficit. So we do look for a weakening dollar because of that increased money supply. So that is something to look at. And Raymond James' target for the year is 1.25 for that. And again, overall, with all the headwinds and tailwinds to equities, we feel that a strong economy and strong earnings growth will outweigh any of those potentials that could cause an issue for equities. And I'm going to pass it on back to Melissa Joy to talk about how we position based on all of that information that we just shared with you.
Thanks, Melissa. I appreciate your comments as well as Alexa's. I think that this is a great time to remember that what has gotten us through the last year, will get us through bear markets, will get us through bull markets, is discipline and process. And when that comes to investing, we've summed that up with our own version of a STEAM acronym. If you are like me and have kids, you'll know that all the rage is STEAM in education, science, technology, engineering, arts, and math. And our own version of STEAM and some reminders for things to incorporate in your investment thinking and process. So one is to emphasize selectivity and diversification. First, on the diversification side, don't only put everything into one investment strategy. While we've told you what we think the trends may be over time, we only talk in probabilities and statistics. And we also know that if you were talking and heard our investment outlook from the end of 2019, we never could have predicted the world we'd be living in today. And so it is not just the information that we have that is available to us, but it's everything else. And diversification can be huge in terms of assisting you with living through uncertainty. But also with selectivity, we have navigated through an overweight in preference for growth stocks. We've been reallocating toward value as we've seen opportunities. Last year, as we were coming out of the bear market, we took the opportunity for some portfolios to purchase high yield. All of those are, selective decisions that we make over time to attempt to help portfolios. So diversification as a rule and selectivity as you see opportunities, I think that it can be a critical component to your success. Even more importantly is time horizon. So don't think about things in 90-day periods when it comes to being an investor, and link your investing strategy with the length of time that you have. With time and patience comes the opportunity to maintain your discipline. So plan for your needs short term, and that goes back into our financial planning process where we do make a plan for cash flow. We're always an advocate of having emergency reserves. That gives us those kind of risk metrics, give us an opportunity to be more engaged as an investor because we don't have to be distracted by, short-term volatility and headwinds. And that goes into endurance and commitment. To me, that means have a process, stick to it. Don't change your process when you have either the market at all-time highs like we have today, which can feel very heady and exuberant, even if the news in the rest of the world is quite challenging. And the same goes when you feel despondent because the market has declined. Like we could turn back the calendar just a year and really, refeel those emotions. To make an appropriate risk profile, when I've thought about risk over the last year or two, I really tell people when we have the right amount of risk in your portfolio that you can live with, that doesn't mean that you don't have to make an extra call to us as your financial advisors to have a discussion when the market is down. But it does mean that we have a high probability of you maintaining your mix of stocks and bonds in any type of market with the assistance of a financial planner. That appropriate risk profile can be critical. And you won't feel it in a time like right now. because the market is continuing to find ways to go higher. When you will feel it is in the time that you could be most impaired by a wrong decision when markets are down. But I think it's important to reflect and kind of reiterate your commitment to your risk tolerance and your portfolio's risk in a time when the markets are higher. It's just helps to kind of emphasize your good behavior. And maintain your allocation parameters, and that goes back into rebalancing. So make adjustments over time, but make sure that you don't just completely, have a strategy one day and then kind of let it roll. And as we manage portfolios, we pay attention to the mix of stocks and bonds so that we can manage that allocation target to fit within your preferences and what is a good fit for you, as well as taking in the input from us as an investment team, as well as the investment strategy group at Raymond James. So with that, this is a great time for us to ask some questions, and I already have one. So thank you so much for sending one in, and I'm going to check again to see if anything else is coming through. But the first question is, and Alexa and Melissa, if either one of you want to pipe in, I'll go ahead and answer it unless you have something to say, but feel free to raise your hand, is how do you see cryptocurrency fitting into future portfolios? Alexa's smiling because we were talking a lot yesterday about the Coinbase IPO, and definitely as our client base has continued, new clients coming on are younger and younger, and we are talking to people who are experienced cryptocurrency investors. We are in a somewhat challenging position because as publicly traded market and regulated by FINRA and the SEC, we are learning what we're able to do and how we're able to advise people in the digital currency space. And it's kind of learning on the job because our regulations aren't set up to include these formats of currency and investments, decisions about how taxes are treated, et cetera. But I definitely, whenever there's an opportunity, I'm trying to expand our options to be able to advise and comment. Also, I would mention that I think it's critical. We don't know what format these will be in. It's a very dynamic, disruptive space. And as with any disruptive technology, change can happen very quickly. But to ignore it, I think would be a mistake. And so we have both been interested in investment strategies that are really forward thinking. When Melissa mentioned artificial intelligence, we're also looking, blockchain has, which is, very important with digital currency, has implications throughout the economy as well. So we've looked at investment strategies that have some components of their portfolios that are exposed to this. And we really think that it's going to become increasingly relevant, and we will continue to update you as we are able to communicate about it more effectively, one-on-one with people who have exposure or who have made money in cryptocurrency in the digital currency world. We're able to have more free-form discussions than in a recorded webinar. Additionally, any questions? I'm just checking to make sure. Any other comments, Melissa or Alexa, or anything I forgot?
Did you want to mention the upcoming event?
Yes, I would love to.
Oh.
Thank you.
I was one slide ahead.
Yeah, I'll keep refreshing my email. But just a couple action steps that you can take. First, we really focus on investments and economics here today. But I will mention, with the potential for tax increases, Melissa was talking to you and Alexa, thinking about an investment portfolio. But tax increases really matter if you're a business owner or an individual, of course. I have found that the last year has been the most critical. There's just been so many financial planning opportunities, individual decisions that can really help a person's bottom line, especially with the CARES Act and everything that occurred in the last year. I do not think that's changing As a company, we are investing in technology that can help us to analyze your tax situation. We are working more and more with people that receive equity compensation as a part of their employment in RSUs and stock options. We are thinking with people through their retirement, and we didn't talk a lot about that today, but some of our other presentations do get into that. And in our one-on-one conversations, we're talking as much about your financial decisions outside of your investment portfolio as we talk about in the investments. And there are so many opportunities and also risks when it comes to, tax, when it comes to your decisions on how to do cash flow. So I just say it's kind of a golden age to be a financial planner. It's extraordinarily rewarding. It's also a lot of work. So I just mention and remind you that when you need to have those conversations, we're here and available for them. So we do have an event coming up next month. If you'll find it on pearlplan.com/events, which is on what to do if you've inherited money. And we have a presentation. Melissa, what's the other presentation that we have coming up?
I have my Women and Wealth workshop on April 28th, and that's in the evening. It is it's going to be a Zoom. I'm hoping to do them in person again soon. Maybe the next one I do them quarterly, but it really is just an open forum. I do have a presentation, but it's very interaction oriented as much as it can be over Zoom, and a space where you can ask questions, and really just a fun evening. So that is April 28th at 7:30 p.m.
Great. And you can stay apprised of all of our upcoming events if you subscribe to our newsletter. And we also make sure to include them on social media. And for the newsletter subscription, you can find it on our website or just send us an email. By the way, here's our contact information. If you did need to send us an email, I don't see any other questions, but just as I'm looking in my email, I see a note: bill to boost the required minimum distribution to age 75 is up for a vote. That's how quickly things are changing in today's environment. Nothing's happened there, but there's a lot to stay apprised of. And we really pride ourselves in being very proactive and thinking through the opportunities that not only do markets provide, but also legislation and bills provide. We have a couple pieces of disclosures that we're required to share with you. So I want to make sure to get those into our recording as well. And then I would just mention that we really appreciate everyone that took the time to listen, or those that listen back to the replay. If you have personal follow-up questions, don't hesitate to reach out to us. And again, here's our contact information. And thank you. We appreciate you. Thanks, Melissa and Alexa.
Yes.